Hello and welcome to the Bank of England's Monetary Policy Report press conference. Good to see you all. To my far right, we have Ben Broadbent, Deputy Governor for Monetary Policy. To my left, we have Dave Ramsden, Deputy Governor for Markets, Banking and Resolution. And to my immediate right, the Governor, Andrew Bailey. Andrew will now open with some remarks.
Well, thanks, Seb, and welcome to the November Monetary Policy Report press conference. Today we've increased bank rate by 0.75 percentage points to 3%. This is the 8th consecutive increase in bank rate since December of last year. We've raised rates by a total of 2.9 percentage points during that period. These are big changes. They have a real impact on people's lives. So why are we doing it? And why are we doing it now when so many people are already struggling with higher energy and food prices and other bills? Well, quite simply, we're increasing bank rate because inflation is too high, and it's the bank's job to bring it down. For a long time, inflation had been low and stable. Most people did not have to worry about inflation, but that has changed. It's changed with supply chain problems after the pandemic, the Russian invasion of Ukraine, and the shrinkage of the UK labour force. Consumer price inflation now stands at over 10%. But I know for many people it will feel worse because the prices of essentials like energy and groceries have risen by much more. People should not have to worry about inflation as they go about their daily business. That's why we've been raising interest rates and did so again today. Low and stable inflation is the bedrock of a stable economy, a predictable economy in which people can go about their lives and plan for their futures with confidence. An economy in which hard-earned money keeps its value. If we do not act forcefully now, it will be worse later on. And as the forecast we are publishing today shows, it is a tough road ahead. The sharp increase in energy prices caused by Russia's invasion of Ukraine has made us poorer as a nation. The level of economic activity is likely to be flat and even fall for some time. But the economy will recover and inflation will fall. We cannot, I'm afraid, pretend to know what will happen to gas prices. That depends on the war in Ukraine. But from where we stand now, we think inflation will begin to fall back from the middle of next year. Probably quite sharply. Now, to make sure that happens, bank rate may have to go up further over the coming months. We can't make promises about future interest rates, but based on where we stand today, we think bank rate will have to go up by less than currently priced in financial markets. And that's important because, for instance, it means that the rates on new fixed-term mortgages should not need to rise as they have done. I want to make some additional points, and there will be some slides coming up, I believe. There we are. To start with, there has been significant volatility in UK financial markets since our last monetary policy report, and indeed our last press conference back at the beginning of August. So the lines in this chart show you the peak level of interest rates expected in financial markets in various economies, and how those expectations have moved around since our last forecast. The expectations for bank rate here in the UK are plotted on the turquoise line. At the time of the August report, the market implied path for bank rate rose to a peak of about 3% in March next year. By the MPC's September policy announcement, which was on the 22nd of September, the peak was 5%, 1 year ahead. On the 27th of September, 5 days later, when turmoil in the market was most intense, the path reached its highest peak at nearly 6.5% in November next year. At the market close yesterday, it stood at about 4.75%, and it's currently lower than that now. Given these moves, we have conditioned our November forecast on an average of the market-implied paths over the final 7 days of our usual 15-day window. This means that the forecast we present today is conditioned on a path for bank rate that rises to a peak of 5.25% during the second quarter of next year. Now, despite the shorter window, this is substantially higher than we had in August. Part of this repricing in UK interest rates reflects global developments. But as this next chart illustrates, there's clearly been a UK-specific component. You can see that in the light turquoise bars. Indeed, these significant moves in UK yields and in UK financial conditions more broadly have occurred in parallel with significant developments in fiscal policy. As we describe in a box in the Monetary Policy Report, the government has announced an energy price guarantee and an energy bill relief scheme. These schemes provide support to households and businesses with their energy bills. Now, the full energy price guarantee will now last for 6 months. Details are yet to follow on the level of support provided beyond that period. The MPC has therefore adopted a stylised indicative path for household energy prices in producing the forecast. The working assumption is that the typical household energy bill is halfway between the announced £2,500 limit under the EPG and the level implied by futures prices under the Ofgem price cap. The energy support policies are likely to limit significantly further increases in inflation and reduce its volatility, while also supporting spending relative to the August projections. Other fiscal measures announced as of the 17th of October also support demand relative to the August projection. But the November forecast does not incorporate any fiscal measures that may be announced at the autumn statement scheduled for the 17th of November. Turning to gas prices, sadly as a consequence of Russia's invasion of Ukraine, I've had to talk at length about wholesale gas prices. I think this is the third press conference we've had to do this. Wholesale gas prices continue to be exceptionally volatile. Spot prices have fallen recently, as you can see from the turquoise line in this chart, but medium-term futures prices have been driven higher by Russia's restriction of gas supplies to Europe and concerns about storage over the winter and beyond. Now you can see that by comparing the orange line for November with the purple line for August. The committee has conditioned its November forecast on the full futures curve for wholesale energy and non-energy commodity prices. And this is a change to the previous convention that wholesale energy prices follow their respective curves for the first 6 months of the projection only and then remain constant. To be frank, I would just describe this as a pragmatic choice we had to make. The new conditioning assumption avoids what would otherwise be a purely mechanical jump in the projection for consumer prices, which would be a product of using the former convention beyond the assumed 2-year duration of the government's support to retail energy prices. Let me move on to the economic outlook. By comparison with moves in financial markets, the news in the economic data since August has been more modest. Gross domestic product has been weaker than we expected. Labour market data have been stronger. And inflation numbers, while high, have come in about as we expected in August. We keep a close eye on the labour market. There are some signs that labour demand is starting to soften, but the labour market remains tight. The unemployment rate fell to 3.5% in the 3 months to August, which is the lowest level since 1974. And as you can see in this next chart, in the purple bars, the number of unemployed people has now fallen below its pre-COVID level. But a key reason why the labour market has tightened since the pandemic is a marked increase in the number of people who are without a job and who are not actively seeking one. The number of such so-called inactive people has risen again since the August report, as you can see in the blue bars, and by more than projected. And sadly, many of the people who are outside the labour market report that they suffer from long-term sickness. I'll say a little bit about the forecast looking further forwards. The MPC expects domestic inflationary pressures to remain strong over the next year, but in its central projection, which is conditioned on the market-implied path for bank rate that rises to 5.25%, inflation then falls sharply. It reaches 1.4% at the end of the second year, below the 2% target, and it falls to 0 at the end of the third year. Contributing to this fall is the purely arithmetic fact that the previous rises in energy prices drop out of the calculations of the annual inflation rate. But in addition, tighter financial conditions and a squeeze on real income slow demand and eventually lead to excess supply and rising unemployment. This downturn in the economy dampens domestic inflationary pressures. In the committee's best collective judgment, GDP will continue to fall throughout next year and into 2024. Compared with previous UK recessions, GDP remains weak relative to its pre-recession level for a prolonged period. You can see that in the yellow line in this chart. There is, I think, however, more to this story. The committee will not pursue a path that we think will drive inflation far below target. The MPC does not follow the market. It sets the level of bank rate to return inflation to the 2% target sustainably, and in a way that avoids undesirable volatility in output. In every monetary policy report, we also publish a projection conditional on a constant level of bank rate, though for the avoidance of any doubt, with the clear warning that it does not mean the committee expects to keep bank rate constant either. But that said, comparing outcomes under this alternative conditioning assumption with outcomes in the central projection gives a sense of how different policy decisions may shape the paths for economic activity and inflation. And you can see that with this chart now, with the dashed yellow line that's been added, which is conditioned on a constant level of bank rate at 3%. And you can see that the depth of the recession is much shallower. Not surprisingly, the projected outcomes for inflation are also different. Conditional on a constant rate, consumer price inflation is projected to be a little above, rather than below, the target at the end of the second year. And let me add a further point before I conclude. Regardless of the path for bank rate, the MPC judges that the risk to its inflation projections are skewed to the upside. In part, the skew reflects the possibility of more persistence in wage and price setting. The upside skew has important implications for monetary policy. Just to put it simply, yes, we project a steep fall in inflation, but there are substantial upside risks to that path. And it's not least for this reason that the majority of the committee judges that further increases in bank rate may be required to return inflation sustainably to target, should the economy evolve broadly in line with the forecast presented in the November monetary policy report. However, the central projections, conditional on the market-implied path of bank rate, serve as a reminder that we should not increase bank rate too far. The MPC judges that the path for bank rate required to return inflation sustainably to target is shallower than that priced into financial markets. There are, however, considerable uncertainties around the outlook. If the outlook suggests more persistent inflation pressures, the committee will respond forcefully as necessary. And with that, Ben, Dave and I will be happy to take your questions. Thank you.
Thanks, Andrew. With questions, usual process. Grateful if you could wait for the microphones to get to you and state your name and organisation clearly when you start. I'll get through as many as I can. And with that, Faisal, then Ed to start.
Simply, another figure in your report is that some mortgage holders face a typical rise over a year or so. £3,000. When they're facing £3,000 energy bills, rising taxes too, how can you justify that they're going to be paying the price for this?
Well, it's a very good question, Faisal. I want to start by saying that we do understand the difficulties of the situation we're in and the difficulties that mortgage holders face. What I would say, however, is I would say two things. First of all, if we don't take action to bring inflation down, it gets worse. I've said this before, but I will say it again. There is no easy outcome to this in that sense, and that's important. The second thing I want to say, and of course this applies to people who will be applying for mortgages or will be rolling over fixed-rate mortgages. There's been a lot of commentary, and quite rightly, about what has happened to the mortgage market in the last month or so, about what's happened to rates and to availability of mortgages. My central view would be that what we have announced today, both in terms of the rate move, which is fully priced in, was fully priced into markets, and the message that you have seen that we've given, I think, very clearly about our view on the market curve, is that therefore this action should not lead to higher mortgage rates. In fact, actually, I think there is a downside to mortgage rates in that sense in terms of new fixed rate mortgages as we adjust, as we must do, and as markets are doing, from the experiences we've had in the last month or so. Now, I fully accept that is more comfort to some people than others, and I want to go back to the point I made at the start, which you rightly highlight. This is a difficult time.
Quite a lot has happened since the last time you sat here for one of these press conferences. We've had 3 prime ministers, 3 chancellors, more U-turns than anyone can care to count. Do you have a sense of how much lasting damage has been done to the economy in the last 2 months for households, for businesses, for everyone?
Well, I think you have to sort of put a number of sort of lenses on that. It's a very good question. So, as we've observed, and I think the first chart showed it very well, actually, there has been what I would call a UK premium on rates. So if you look at how UK rates have moved since we were here at the beginning of August compared to the Euro area and compared to the US, which that chart did, you'll see they've all gone up. But the UK clearly went up far more, and it went up during this period when there was, of course, considerable turmoil in the markets. Now, the first thing I would say, and the important thing, is that we are seeing that unwind now. I mean, that is substantially unwound. We're substantially back to certainly where we were when we had our last meeting in September, which was just before that. And that's obviously a good thing. Market liquidity, though, I think, and Dave may want to come in, is not back to where we were. The third thing is, and I think this is an issue that we have to face up to. I was very acutely aware of it when we were in Washington recently. Is that there has been a questioning of UK policy. I'll use UK policy broadly here. It's not for me to talk about. But I'm not going to talk about politics. I'm just going to talk about policy now. And that will have some lasting effect, and we have to work very hard to put that in the past, frankly. Do you want to say anything about market liquidity, though?
All I would add is we have seen that round tripping back to where rates were on the 22nd of September. That was the day of our last monetary policy meeting. It was the day before the government's mini-budget. And so you've seen that, for example, the 2-year OIS, 2-year swap rate, which is what 2-year fixed rate mortgages are priced off, that was 4.5% on the 22nd of September. It peaked at 6%. It's actually come back to slightly below 4.5%. Now it's at 4.38% as of a few minutes ago. That obviously hasn't fed through into mortgage pricing yet, which was the point Andrew was just alluding to. But although we're seeing those kind of round trips, whether there or in the 10-year bond yield, it's clear that markets remain febrile. There's illiquidity across different parts of the market. So I think things have not settled down yet, and that's obviously something that we're very focused on in terms of monitoring market conditions.
Can I have Jemana and then Chris?
Joanna Versace from CNBC. The Fed Chair Jerome Powell yesterday suggested that the bigger risk was one of under-tightening versus over-tightening. I just wonder if you have the same view as well, given even with a 3% constant interest rate, you have an inflation forecast of 0.8 percentage points 3 years out and 8 consecutive quarters. Actually, no, with the 3%, it's 6 consecutive quarters of negative GDP. Thank you.
Well, I'll bring Ben in at this point. I mean, I think there are things that we share in terms of our experience and assessment with the Fed, and then there are very important differences between what certainly in the UK, but actually I'd say Europe more generally are experiencing in terms of shocks from what the US is experiencing. And I do think in the commentary and in the discussions it's important to draw out those distinctions as well. So Ben, did you want to?
Yeah. Excuse me. On that 3-year forecast, you've got to remember gas prices are falling quite a lot, so it doesn't give you the straightest picture of sort of underlying inflation on that constant rate assumption. But as Andrew says, there's a big, big difference between what's gone on both with inflation and growth between US and Europe. And as Andrew says, it's not always made that clear. So the pandemic was a common shock to all of us. The war is not. The gas prices have gone up hugely in Europe, not much at all in the United States. They're still barely 10% in the United States, wholesale gas prices, compared with those in Europe. Just as a measure of the difference in growth, I just wrote down before I came up the PMI indices, which are a good high-frequency and up-to-date measure of growth, at the beginning of the year and what they are now. And at the beginning of the year, they were, all of them in the UK, US, and Europe, very healthy, above trend, coming out of the pandemic. So 54 in the euro area, 57 in the US, 58 in the UK. Right, the latest readings of 58 in the United States, that's higher than it was just before the war, and they're down at 47 in the UK and Europe. We've got a really, really big difference between the path of growth here, and by here I mean in the continent of Europe, versus the United States. You see similar differences now in the composition of inflation. And I think that explains quite a lot of what divergence there is in policy, but also, for example, a part of the strength of the dollar against both the UK and the euro. And it's a big difference. The pandemic, as I say, was a shock felt by everybody. This one is very differentiated.
Chris Giles from the Financial Times. I'd like to ask a question about the interpretation of the forecast on two grounds, if I may. The inflation forecast is closer to your target on the constant 3% rate assumption than the market path going up to 5.25%. So would people be correct in assuming that was closer to where you think the terminal rate should be, somewhere close to where it is today, than going up? And secondly, the forecast is conditioned on fiscal policy not changing on November the 17th, when the Treasury is suggesting a large fiscal tightening of maybe up to 2% of GDP. How would that change the inflation forecast?
Well, I'll start. So Ben and Dave may want to come in. I'll do it in reverse order if you don't mind, Chris. I think the answer to your second question, of course, is that we will. We always condition on announced fiscal policy. Now, as I explained in the introductory remarks, we've had to sort of think quite hard about, in the context of the energy side, what the word announced means, and put what I think is a sort of stylised but sensible interpretation on it. But on the other measures, which, as I said quite explicitly, they do not appear in the forecast, we will, of course, take those into account when we next meet, and then in our next forecast, as we always would do. And we'll see what the Chancellor announces. I think my answer to a really, really interesting question on your first part to your question is the last chart we put up, which had the sort of you could see the difference between the two parts, if you like, in GDP terms. And as you rightly say, you can use a similar inflation chart. I would just emphasise the point that there is an upside risk on inflation, and it actually is in MPC history. It's one maybe the largest actually upside risk in MPC history, and that reflects certainly the labour market. Obviously there are issues around gas prices, sadly, as well. So we're very clearly not saying, we're not putting our sort of, our bet either way in terms of which is the better curve, but it's important that since we do think the market curve is too high, that I think it's useful as a sort of guideline to show where the alternative is. But where, obviously where the truth will lie in between the two, we're not giving guidance on that because, we don't predict market paths precisely. Dave, you want to?
Just to add to what Andrew said, so we've got this historically large skew on the inflation fan chart, which is our way of quantifying that upside risk on inflation. And I think that reflects the factors that we've been focusing on more and more through this year, which is concerns around persistence of inflation from domestically generated inflation. That could be because of the tightness of the labour market, but equally also from firms looking at an environment where they think they can put up prices, and those kind of inflation drivers carry with them the risk of being more persistent. Hence, the communication that we gave, that the majority of us, assuming that projections broadly follow the numbers that we've just published, think that we'll have to make further increases in bank rate to get inflation sustainably back to target. And to your other point, I wouldn't be thinking in terms of looking at those two constant rate or current rate paths to work out where we think the neutral rate is. That's not something we are focusing on. What we are focusing on is where we think interest rates have to go in the meantime. That's the focus, and that's of our communications.
Just one tiny thing. Obviously, the fiscal announcement coming. What matters for us is the effects of fiscal policy in our forecast horizon. And the government's planning horizon may be slightly longer than that.
Can I have Lucy and then Ashley, please?
Lucy White from the Daily Mail. Governor, you said in your opening remarks, fixed-term mortgages should not need to rise as they have done. You've addressed that. What would you say to the lenders who have been, putting their rates up in recent weeks, and what would you say, in terms of responsible lending for the future? And what would you say to the consumers who have had to lock in over the last few weeks, either because they thought the picture was going to get worse, or because it was the time?
Well, it's a very good question. Well, I start by saying that because the mortgage market in this country over the last decade or so has moved quite substantially from being a variable rate market to a fixed rate market. Not, of course, fixed rates in the sense that the US knows in terms of duration, but nonetheless much more of a fixed rate market than a variable rate market. Now, fixed mortgage rates are priced off the market curve because of the swap, because there's a swap involved in there for the lending institution. So that whereas variable rate mortgages traditionally are priced far more off our rate, if you like, as it moves, fixed rate mortgages are priced far more off the market curve. Now, the reason I say that's important, of course, is that as we saw, and we've illustrated and said, as we saw this real, blow up of the market curve as it happened, that obviously had an impact on pricing mortgages. I think it also, Dave was making this point as well, it also made lenders pretty uncertain, of course, about what they were facing in terms of making offers which would last for however long. And I think that explains two things that you point to. One is the increase in new fixed mortgage rates, and secondly, the withdrawal of offers from the market. Now, it follows from, I hope, I would suggest from what we've said, that is now it's calming down, the curve is coming down, so pricing off the curve, is getting more predictable, I think, and the curve itself is coming down, and that should be reflected through, as many commentators, and I know quite a few of you have said in what you've written in recent days and in the last week or so, that should be reflected through into mortgage rates. I mean, these things have to be symmetric in that sense. So that would be my view of how it should evolve. I'm not going to give predictions of precise mortgage rates. That's not something I think that's our job. But I would expect that pattern to be reflected through. And so therefore I think people who are now in the process of going for new fixed rate mortgages or rolling over should obviously get those terms. To your point, though, of course, I think it is very unfortunate that those who've had to take mortgages out during this period have faced a much more difficult situation.
And just the facts on that, we will be publishing numbers tomorrow that we cover in the minutes, but the quoted rate on a 2-year fixed rate, 75% loan-to-value mortgage, 6% in October, which is its highest since 2008, whereas it was 3.6% in August, 4.2% in September. So it's clearly, the spread on mortgages, which was quite compressed, has opened up a lot, and there is a lag, so it will take time for mortgage pricing to reflect that. But we will wait to see how mortgage pricing does reflect the fact that the reference rates that I was giving you earlier have come down a lot from those equivalent peaks. I mean, what was striking was that the pass-through was very quick on the way up. So it gets back to Andrew's point about looking to see how quick it is on the way down.
Ashley.
The Sun. Two, if I may. You mentioned the UK premium. It has been called reader things, but let's call it the mini budget premium as well. I mean, how much would you think that interest rates and inflation, interest rates would have to rise if there hadn't been this instability in the gilt market that we saw, and kind of that knock-on effect? Like, how much is that having an impact on this? And the second point would be, given that we are going to go through what you're predicting, a 2-year-long recession, the longest since we've had since the 1920s, do you not think that adding to the household pain of adding interest rates at that time, we're already seeing that the economy is slowing, we're already seeing these indicators, why should we be kind of having that higher interest rates during this painful period as well?
Well, let me start. It really isn't possible to do what I call a sort of counterfactual interest rate, counterfactual MPC decision. What would we have decided had none of the sort of the events of the last sort of couple of months actually happened? I mean, I did say earlier that there has been relatively much less economic news, but I mean, I would, however, emphasise that the components of the sort of the risk the upside risk that we see to inflation towards the end of the forecast are really related to the labour market. So sadly, some of it to, I suspect, gas prices as well. And those things are not, of course, to do with what's happened in the last few months. So I would sort of really only draw those points out. It's not possible for us to do what I sort of say counterfactual MPC in that sense. On your point about the recession, I'd really go back to, I think, a point I made to Faisal in his question, which is the fact of the matter is that if we don't tackle the inflation, then the problem gets worse. And that would rebound onto, frankly, both the duration and the nature of the recession, I think.
I just had one thing, a word of caution on the duration. If you look at for what it's worth, the central projection that the quarterly numbers as you get into the second year of the downturn, they're very small. Right? And in particular, they're very small compared with the kind of standard error around this. It really wouldn't take much either to lengthen or shorten that duration considerably. The important thing for us is what is likely to be the increase in spare capacity required to ensure that domestic inflation returns sustainably to target. And after allowing for the negative effects on demand of the very same shocks that have pushed up inflation, energy, pandemic, and so forth, how much more is there left for us to do? And it's in the nature of the extraordinary sequence of difficult shocks the economy has faced that at the same time it's pushed up inflation and yet depressed growth. And unfortunately, as Andrew said, it's very important that we do our job and make sure that inflation does not persist for longer than it should. But as far as the duration, as I say, the predicted duration is concerned, I wouldn't be that confident about the precise number of quarters, frankly, given the shape of what we're forecasting. It's quite flat as you get to the end of the downturn.
Larry, then Zoo, please.
Larry Elliott of The Guardian. The bank is saying that we're about to have a 2-year recession. 2 members of the committee didn't vote for a 75-point increase. You're saying that on constant rate assumptions, inflation would be quite close to its target in 2 years' time. I know you're not saying where you think rates are going to peak, but couldn't people be forgiven for thinking that rates are going to peak closer to 3% than the 4.6% currently being anticipated by the markets? Isn't that the message that you're actually trying to send out here?
Well, by the way, I think you were saying this, Larry, but just to be absolutely clear, of course, the constant rate assumption is post the increase. It's a 3% constant rate in that sense, just to be clear. I mean, you'll probably criticise me for stating the blindingly obvious at this point, but I mean, in a sense, what we are saying is that, our sort of, our best view of what the rate should be, given the circumstances and the evidence we have to date, is nearer to the constant rate curve than the market curve is to the constant rate curve currently. Now that's, as you say, thank you for that statement to the blindingly obvious, I think you'll probably say at this point. But just to reiterate, I mean, we do not have a precise alternative path, because the reason I had to somewhat labour in my opening remarks the conditioning assumptions is that we've made more changes to the conditioning assumption this time out of necessity than probably we ever have before, actually, because things have happened. But those conditioning assumptions are, of course, an important part of determining sort of the outcome in terms of where the forecast takes you to. We can then apply sort of our judgment over that, which we have done. But our judgment doesn't lead us to a precise number in that sense.
Can I just be clear on another factual point, which is that the conditioning path for the market rate base forecast was an OIS curve with a peak in bank rate of 5.25. So not the current level of bank rate. It's the 7 days was implied a peak bank rate of 5.25.
Yeah, I mean, we have to cut off so that we can actually produce the report.
Yeah.
And it's a sign of the times that the curve has moved quite a bit since we actually cut off.
That's it.
Just to follow on from what you guys have just said, why have you decided so explicitly to push back against those market rate expectations? And I know you just said that inflation risks remain skewed to the upside.
Yeah. Well, Ben developed this thought in his speech the other day, so I'm going to let Ben develop it some more.
If there is, I hope it's reasonably clear in the minutes. We think that it's likely, given this forecast, that further rate rises will be necessary. But if you think of that comparison that Andrew began with between what the market was expecting at the time of the August report, without commenting on whether either is precisely right or wrong, but the scale of the move in the predicted peak over the following 2 months was enormous. So it's perfectly possible, and this is where we are, to say we think further rises will be likely to have to occur, but we also think they're not likely to have to go as high as 5.25%, given everything else in the forecast. I mean, both those statements are true. And the point about forceful is veering more towards a conditional statement that's very important that we always make, that what actually happens will depend on the shocks that actually hit the economy. And the thing to take away, I think, is not so much that we have some particular value of interest rates that we're telling people we're going to go to. We will do whatever is necessary to ensure that our projections of medium-term inflation are sustainably close to target. And on this particular forecast, it suggests that, we don't think it wouldn't be, if the things turn out like the forecast, necessary to go to 5.25, but yes, further rate rises are likely to be necessary. So both those things are true.
Thanks, Phil, then Marie.
Thanks. Phil Aldrich at Bloomberg. Can I just get a point clarified to begin with? Because you talk about the correct path of rate rises doesn't need to be what has been priced into financial markets. You mentioned 5.25% peak, and you mentioned 4.75% peak in the documents in different places. So are both of those market paths too high, or are you being specific about a single one? So just a point of clarity. In the sort of newfound spirit of clarification, of collaboration between fiscal and monetary policy, I'm just wondering if you've got any ideas about what measures might help the bank hit its inflation targets, more fiscal tightening, and particularly with regard to the job shortages, if there's anything that could ease job shortages, just those kind of policy measures.
Well, I'll do the second. Dave may want to do the first, I think. I'll do the second. I mean, sort of nice try to get me to sort of lecture the government on what its policy should be, but it really is for the government. I mean, I think our report lays out the situation. It lays out the issues that the economy faces. You're right, and it's why I made the point that I think in everything that's been going on recently, we should not get away from the fact that there's a real issue in terms of the size of the labour force in this country, which has shrunk. But it's not for me to prescribe what government, or even suggest what government policy should be.
Just to set out as clearly as we can, I mean, I think it is set out in para 16 of the minutes. The MPC's projections were conditioned on the path of bank rate implied by financial markets in the 7 working days leading up to 25th of October. That path was rising to a peak of 5.25% in 2023 Q3. So all the forecast numbers based on the market path, that's where the 5.25 comes from. We then just report that, and this goes to my point that markets remain febrile, even these pretty liquid markets, that in the run-up to our November decision yesterday, the peak had come down to 4.75, but the conditioning path is the 5.25.
Hi, Mehreen from The Times. Just on what happened today, given that inflation is still in line with your August forecast, the fact that we've had a financial tightening and that we can expect fiscal consolidation, is the reason that you opted for 75 today because it was priced in by the market, and not delivering that would have produced maybe more volatility than you would have liked in this febrile environment? And is it fair to say that we're not going to be seeing 75 moving forward? And another question, the Fed yesterday stressed that it is now thinking about the cumulative impact that its rate rises are having on inflation. Are you also going to start thinking about all of the action you've done so far and the sort of variable lag that's now going to have on the economy and inflation going forward?
I was tempted to say the answer to those are no and yes. No, in the sense that we do not follow the market. We obviously condition on the market path for the forecast, but I would draw a distinction between the forecast and our judgment on the policy decision. And you can see that from the way we've described our thinking on that, and our thinking on the forecast path conditioned by the market. So no, we don't. We don't follow the market, and we are prepared, as you can probably recount from the past. There are times when we're prepared to diverge from the market path and accept that would obviously lead to some repricing. So, I think that's a very important one. Did you want to come in on this?
Well, only to make very clear, because I hope it's clear in the minutes, what led to this decision. Now, we're always looking at all the data. We saw upside surprises in wages and in activity. And that's been a key area of focus for the second round effects of higher food and energy and other imported goods prices. That's been important for a while, and we saw another upside surprise in that. And we don't know yet what's going to happen with fiscal policy, and in particular, following Chris's question, fiscal policy in the relatively near term, which is what affects our forecast. What we do know is that the energy price package will be a significant support to demand relative to the August forecast. And each of those two things justifies tighter policy. And we are always led, taking account of what we've already done, to link it to your second question, to think about what is the right level of interest rates and the right path to hit the inflation target. We do not just simply reflect back what the market already thinks. I mean, it's their job to follow us, not ours to follow them.
And just on this point about do we take account of what's already happened? I mean, as Andrew set out in his opening remarks, this is the 8th consecutive meeting that we've put up rates. So every meeting since December 2021, when rates were at 0.1, we've been raising rates by a cumulative now 2.9%. And we are very conscious of that cumulative impact is feeding through onto the economy and is adding to the challenges that households and businesses are facing. So I think we've been pretty consistent in flagging that cumulative effect.
I just on your second question, I just emphasise that point because one of the things obviously we do spend quite a lot of time on is the transmission of monetary policy. So how each of our decisions transmits into outcomes. And we are obviously, as we approach the anniversary of the first interest rate rise, and given what we know about the transmission mechanism, yes, of course, that the impact of the transmission of our earlier decisions is obviously a factor in our consideration. And of course, we also, by the way, have to consider, going back to the question on mortgages, of course, we also have to consider how the transmission mechanism changes and adapts over time as aspects of the economy and aspects of the financial system change.
Thanks. Isha?
Lag in monetary policy, when do you expect today's rate to be felt on your inflation, inflation in the country? Like, when will people expect to experience that? And are you waiting to see evidence of inflation going down in domestic price pressures as well as those global factors before you think about slowing down or even ending this current hiking cycle?
There's a very good question. Yeah. We're focused, as always, one of the reasons we use the forecast both to think about policy and describe it is because of the lags that you discuss. And I'm not trying to suggest that there are very precise estimates, but typically you might expect a peak effect of an interest rate change on demand, a year or maybe a little bit less, and inflation, say, 18 to 24 months, or maybe longer than that under some circumstances. So it's because of those lags, indeed, that we have a forecast in the first place. What will determine how long this goes on for should be seen much more in the context of that forecast, which depends on lots of things and lots of indicators rather than any single one. We have stressed the domestic labour market as one key indicator of domestic inflationary pressure. But I wouldn't want to pick out one single indicator even within that, frankly. But it's more, as I say, to do with our assessment of medium-term inflation. And there are lots of things that go into that forecast, rather than the current rate of inflation. And precisely because of the lags you talk about. And I'm not going to say that means, that interest rates will either stop going up at this particular point or peak at this particular level. We don't know yet. But it's a slightly broader framing that we consider rather than any specific indicator.
Jack, please, and then Francis.
Jack Barnett from the City AM. On both of these projections you've got on the constant rate and the market rate, they're pretty bleak on both sides. Are you essentially saying that this path to the so-called soft landing is now kind of dead? We're not going to avoid this recession. We actually might even need this recession to push down inflation to complement rising bank rate. And then just secondly, you obviously mentioned there that we're approaching the year anniversary when we first raised interest rates. Just kind of taking a step back from maybe all of you, how sharp has the swing been in the economy's performance when we were going into that meeting to now?
Excuse me. Well, let me start by saying, I think when we look at the path of the recession, it's worth bearing in mind always the sheer size of the shock that we have experienced to real income in this country. Call it terms of trade shock, if you like, from events, and particularly, obviously, during the course of this year, from events surrounding Russia's invasion of Ukraine. This is a huge shock. It's very interesting. I think Ben has said in the past that if you compare this to the 1970s, and you compare this year to single years in the 1970s, and obviously government policies also come into play there in terms of energy markets, this is a bigger shock than we saw in a year in the 1970s. So while I don't for a moment want to sort of wring my hands and say a recession is inevitable, when you look at those paths, you have to look at them in the context of the shock that the economy is experiencing, and sadly, of course, the people of this country are experiencing. So I would put it into that context.
And we were never, I mean, you say we're now not saying it's a soft landing. We were forecasting recession in August, if you remember. This is not the first time we've forecast a recession. And as Andrew emphasises, the difference, I mean, soft landing is often used to describe the aims of policy tightening in the United States. And I emphasise answer the question I gave earlier. We're in a very, very different position. Because on its own, the rises in import prices of goods, of food, of energy, will depress growth here. We then have to decide, relatively, how much more do we have to do to ensure that the combined pressure of those real income hits and monetary tightening bring inflation back to target. But I don't think we've ever said we're aiming for a soft landing. We're aiming to bring inflation back to target. That's what we're aiming to do. And it's been a feature of the forecast for a long time because of the nature of this shock that growth, our forecasts for growth have got progressively weaker. And as I say, we had a forecast recession in August. And you ask about the turnaround. This time last year, before energy prices really started rising, the forecast had, the central forecast, I think, was for GDP growth of over the following year, so to the fourth quarter of this year, of almost 3%. And it's now 0.2. That's already happened. That's a measure of the scale, not so much of the tightening in interest rates because of those lags, but the direct effect of the huge rise in import prices, particularly energy.
It's also, I want to say something, it's interesting just to recall this time a year ago when we were sitting here a year ago, and the issue we were wrestling with, and of course, I remember the decision we took at that meeting was, attracted a lot of commentary, let me put it that way, but the issue we were wrestling with then was really in my view, was the labour market and what was the impact at the end of the furlough scheme on the labour market, and it remains an important issue in the sense that the labour market remains important, and the whole question of the tightness of the labour market remains important. And I think we, like other forecasters, were surprised, I'll say this, that the ending of the furlough scheme didn't lead to any loosening of the labour market, any really marked and certainly prolonged rise in unemployment. But I say it also because, just to recall, I mean, it is interesting to put into context just how many major events have happened in the intervening period. I mean, it is pretty striking. We go back to a year ago, what the issues were a year ago, and then everything that has happened subsequently.
Francine.
Francine Lacqua, Bloomberg TV. Governor, now that you've started QT, do you have any estimates on how much tightening that will impart?
Sorry, how much tightening?
On QT, now that you've started QT, how much tightening does that impart?
I'll hand over to our resident QT expert.
I'll differentiate the answer from the one I gave previously. I mean, we've always thought of QT as being very different from QE in the sense that when we were doing QE, we were trying to send a signal about what was going to happen to bank rate. That's clearly not the case with QT. And also, we quite often did QE at times when markets were really not functioning well, and those episodes tended to be when QE had its most significant effect, which is why we talk about QE being state contingent. QT is also state contingent, but we've made clear, the MPC has made clear that it would not do QT under issues of market dysfunction. We did pause the start of our active gilt sales by a few weeks because of what we were seeing, particularly at the long end of the government bond market back at the end of September. So we paused we were planning to start in early October. We didn't start until Tuesday when we did our first auction and carried that off successfully. 750 million proceeds, one of 8 auctions we're going to do in the remainder of this year, a total of around 6 billion. And I guess the final point I'd make is throughout the way we've planned our QT programme, going back to last August, we've tried to be deliberate. We've always said that we would do this in as predictable a way as possible, and that means it should be priced into markets as and when we do it. So it's impossible to extract, what was the exact effect either of the total programme that the MPC has set out, which is 80 billion over a year, or of any particular auction.
If I could just add, just on the state contingent point, I think there is also, certainly in the current context, another piece of state contingency, which is that, as quite a few market commentators will tell you, and a number of you have written, I know, there is currently quite a wedge between the unsecured rate and secured, GC collateral rates in the repo market. And that, of course, is relevant to us selling assets into the market in many ways. People are saying to us there's a shortage of collateral in the market at the moment. So in a state contingency sense of the immediate context, that's relevant. And actually, to your question, Francine, that would suggest that our sales are not going to have that much impact in that sense, cumulatively.
And indeed was why when we published the revised plans for the sales, we deliberately skewed the sales to short and medium buckets so that we can support the market by providing collateral, and equally given still concerns potentially at the long end, we thought it was we can start selling from the longer end of our holdings in the new year.
Thanks. David.
David Milliken from Reuters. Just on a point of clarification, Governor, when you were talking about the likely path for rates being likely to be closer to a constant path than a market rate path, were you talking about the market rate path?
I didn't say that. No. What I said was that it would be, if you think about the gap between the market path we have in the forecast and the constant rate path, I said that our commentary would suggest that the path would be nearer to the constant rate path than the market rate path in the forecast. And and I'll repeat the apology I made to Larry. That's a statement to the blindingly obvious. There's nothing more than that.
It amounts to saying simply that we thought we wouldn't have to get as high as the market curve given the forecast we had.
Yeah. And sorry, just to finish that part of the question.
Sure.
So it was that were you talking about the market rate path as it was at the time of the forecast when they were set, or the market rate path as it is today?
Yeah, and the market rate path today is lower. As I was saying earlier, that's an interesting feature of the times we live in, that although not that much time has elapsed since we came to the end of the window for the forecast, actually it's moved quite a bit since then, and it's moved downwards. But as I said, we're not giving, we're not giving a here's our line. That's not what we do. So I'm not going to comment on how much is today's curve, in the right place relative to what it was a week ago.
We've done one. The statement is about the market path at the time and underlying the forecast we've just published, not what it is minute by minute.
And more broadly, do you feel the sense that you're flying blind a little bit with still a huge amount of uncertainty about government fiscal policy and what exactly is going to be coming up, how much tightening we're likely to be getting?
Well, go back to what I said earlier. We moved on from what you might call the long-established definition of announced in terms of fiscal policy, in terms of the energy package, because, if I can I think I can describe what the Chancellor has said. If you think about two bookends, this is what happens after April, obviously what happens between now and April is set. If you think about two bookends, one of which is that there is no package off, there is no household support after April. The other, which is that the full package remains in place. I think it's clear that the Chancellor has said that neither of those are things that he intends to pursue. So it would obviously not be sensible for us to condition on those two, and therefore I think it was required and natural that we had to make an assumption that fell somewhere between the two. But it's frankly a stylized assumption. It's not in any sense us saying, well, we know what's going to happen, because we don't actually in that sense. And then on the rest of fiscal policy, we have followed our normal practice that if it isn't announced, it isn't in there, as it were. So whatever else the Chancellor's going to say at the fiscal statement that's going to come up, that does not feature in our forecast because it is not government policy as of now.
We're in last question, and I think Lucy.
Lucy Hager, Market News. The bank's projections show unemployment rising to 6.5% in 3 years' time. Does the bank see this as more of a normalization in unemployment levels, or is it of concern? And as far as unemployment goes, do you see the risks as being more skewed to the upside or downside?
Well, I'm sure Ben and Dave want to come on this. If you talk about the term normalisation, you can interpret that in a number of ways, it seems to me. Is it normalisation relative to history? Well, I don't think our job is not to normalise relative to some point in the past, because that's not the context we face now. Now, of course, another way of expressing this question is to go to the concept of a neutral rate, or the concept of R star, as it's often called. And certainly speaking for myself here, I think there are two parts to that story. One is what you might call the shorter run cyclical element of it, and then the other one is the longer run structural element, which I did make a speech on earlier in the summer, and with some colleagues have published a paper on, although I have to say they did most of the work and I didn't, but so they get the credit and I get the blame. On the longer, which is entirely fair, on the longer run point, on this sort of more structural point, what I would say, and that's the conclusion of the work that we did publish, is that the longer, and these are global drivers, they're not UK specific. I think the more cyclical thing, you can talk in somewhat more in UK terms. On the longer run issues, what did I say?
Academic.
An academic is calling, yes. On the longer run point, I think, the point we did make in that paper, in that speech, was that the longer run global drivers are very slow moving structural drivers, particularly population aging, which is obviously a global feature. And it's hard to see that those things have sort of, have run their course, as it were, at the moment, and particularly played fruit. So the conclusion we drew from that was that we didn't see that as being a long-run, change in that sort of context of the neutral rate, or R star, going upwards. I think the more cyclical element, of course, yes, I think you can see some upward movement in it for reasons that sort of, in a sense, underlie what we've published today. Do you want to add?
No. I mean, on unemployment, for what it's worth, there's also a natural rate estimate we have of that, and 6.5 is very clearly above that. And of course, any rise is regrettable, whether you think it's coming from below or coming from above that natural rate. But it's, the complement to a recession. This is what tends to happen. And we've discussed at length the underlying causes of that recession and that downturn. The risks, I think, both on all the real side of the forecast, I think Dave will correct me if I'm wrong, GDP and unemployment are balanced. They're neither skewed in one direction or the other.
Well, thank you very much for coming. We're out of time.
Thank you very much.